This is Michael Collins, State Specialist with Family Living Programs, UW Extension Cooperative Extension. This is part of the Lunchtime Learning series as part of the fyi.uwex.edu/financial series website. Every month we take on a different financial topic. Today we're going to talk about financial capability and specifically the use of financial capability data for Wisconsin. Today's information is going to be posted on the fyi.uwex.edu/financial series website, and a brief will also be posted, which is about a 4 or 5 page document outlining many of the topics that I'm going to talk about today. Oftentimes we do these as phone calls where people can ask questions live. Today we're going to try a new experiment where we're going to post the information and allow people to ask their questions by posting questions online. So if you post your question, I will try to post a response to them in the next couple days. So hopefully this works out, and let me know what you think. Today we're going to talk about financial capability, and specifically how financial capability differs from financial literacy. Financial literacy really is the bedrock of financial capability, but I think as we've learned more about financial literacy and about how people apply their knowledge to their behavior, we realize that it takes more than just knowing. It takes more than just understanding terms and definitions. There's a need to have the ability to act. And so financial capability is a bit of a broader way to think about how to encourage people to do the best they can given their financial situation. Financial capability we can think about as the ability to acquire resources, to evaluate options and make decisions, and to apply their information and their skills to their behaviors, whatever behaviors are appropriate for them. And it's also something we think about over the whole lifespan. So financial capability can apply to people in elementary school and high school, as well as to people who are trying to manage their money in retirement. It's really having the tools and resources to make decisions at the point in time that you're at. Here's one way to think about financial capability in this circle diagram. You can see that knowledge is still a big part of what we think about for financial capability, but we also have these other influences such as beliefs and attitudes and past behaviors that influence our knowledge, that influence our actions, and become those resources that we can draw on when we need them. There's also an important role for access to financial products and services. So knowing what to do but not having access to an account or a particular form of credit might inhibit our ability to take action. What's exciting, I think, about the financial capability concept is we actually have some new measures that go beyond just knowledge or just problems that we observe, like bankruptcies or foreclosures, at the level of the household for Wisconsin. So the FINRA Financial Education Foundation, Investor Education Foundation, did a survey in 2009 of everyone that was supposed to be representative of everybody in the country, and then also representative of people in the military. And then they did subsamples of every state. So between 500 and 800 people in every state were part of this survey that was conducted. The data were then weighted to represent, hopefully represent the sort of general trends of people in the state of Wisconsin. And this was conducted in 2009, released in 2010. The survey was conducted again, or a very similar version of the survey was conducted again in 2012 and will be released in the next few months. So by June or July, we ought to have another slug of these data that allows us to look at changes between 2009 and 2012. All the data are available online at the usfinancialcapability.org website. There's a clickable map I'll show you in a minute where you can go through and fish around the data and look at it yourself. Just some highlights. About 55% of people in Wisconsin are living paycheck to paycheck, about the majority, and that's pretty similar to the U.S. average. About 57% of people in Wisconsin don't have a rainy day fund, which is a little bit lower than the national average of 60%, but still, up to 2 out of 3 people don't have any cushion. About 19% of people in Wisconsin used a payday loan or a pawn shop loan or rent-to-own, similar kinds of alternative borrowing service, which compares to about 24% nationally. A little bit lower than the national average, but still we're talking about 1 in 5 people are using these alternative credit services. And then on average, people in Wisconsin got about 3 out of 5 financial literacy questions correct. I'll show you what those questions are in just a minute, which is about average with the rest of the country. So here's the Financial Capability Study website, the link I just showed you before. If you click on that link, you can see that a map comes up, and I've already highlighted the state of Wisconsin. And then when you click on Wisconsin, you can see they've summarized both the Wisconsin and the U.S. Averages for a number of the questions that they ask. So rainy day funds is the one I'm looking at here. But if you look at the website, you can see other data for Wisconsin and see how it compares to the national average. It'll be exciting in later this year to see the 2012 data side by side with the 2009 data. So I tabulated some of the findings for Wisconsin and the nation relative to the region for some questions that give us a handle on not just what people know, but what they're doing. So for example, under making ends meet, you can see that spending where people say their spending has been more than their income. About 17% of people in Wisconsin and 20% of people nationally, this is the third row down, say this. And so about 1 in 5 people nationally are spending more than their income. Now 2009 was the midst of the recession, but still, that's a pretty high share. We know that can't be sustained for very long. Difficulty covering expenses. So people who say it's been very difficult to cover expenses and paying bills, about 16% in Wisconsin and 18% nationally. About 35% of people in Wisconsin and 40% nationally say they had a large unexpected drop in income. An important thing about financial capability is it's how do you react to these unexpected events. Financial capability, no matter how much you know, isn't going to change bad things can happen, whether it's a job loss or a spouse loses work hours and you have a drop in income. And financial capability gives us, hopefully, the tools to be able to respond to those issues, those triggers when they come up. Other kinds of questions that might be interesting here are, people who use their retirement account. About 8% in Wisconsin or 10% nationally took a loan against their retirement account for day-to-day spending. And between 7 and 8% took out a hardship withdrawal. So again, these are examples of how we might use these data to better understand the needs and issues of families in our state. Here are some more questions around use of financial products. So you can see that the national average and the Wisconsin average are exactly the same. About 91% of people have a checking account. But only about 79% in Wisconsin or 74% nationally have a savings, a money market, or a CD, some sort of longer-term store. And then if you talk about non-bank borrowing methods, about 19% of people in Wisconsin and 24% of people nationally used one or more non-bank borrowing methods, like an auto title loan or a payday loan, a pawn shop loan, a rent-to-own, a refund anticipation loan. And these are important services for people who are in trouble. And the Wisconsin rate is a little bit lower than the national rate, but still it's an important trend for us to understand. Other issues that we see in these data are the ability to use credit cards. About 44% of people in the state say they always pay off their balance in full. And then if you go down a couple more lines, 35% paid the minimum only. So we have a sort of split between people who pay just the minimum and pay off everything in different places that people might be at in their life course to be able to do that. I'll talk a little about the financial knowledge questions. These are knowledge questions that are used quite frequently in surveys to understand and measure how much people know about financial literacy. And these questions have been used in lots of different surveys with lots of different populations in a very similar format. The first one is about compounding. Do people understand that interest earns interest, and so that if you had $100 saved for 5 years at 2%, you would have more than $102. The second one is about inflation, that if your savings rate is 1% and your inflation rate is 2%, that you'll actually be losing money in real terms. The third one is about interest rates, and this is a hard one. A lot of people get this one wrong because if you're not living it or you're not have been trained in how bond prices work or interest rates work, you might not know that interest rates and bonds have inverse relationships. So as interest rates go up, bond prices fall, and vice versa. The fourth question is around mortgage terms, so a 15-year versus a 30-year mortgage, and that the total interest paid on a 30-year loan is greater because there's twice as many periods. And then the last one is about diversification, putting all your eggs in one basket, that a single company stock is going to be riskier than a mutual fund. So these are 5 questions that are widely used. Mostly true, false, do you know or don't you know the answer, and then sort of yes, no, true, false. And you can see in Wisconsin, people on average got about 3.1 of these correct. Nationally is about 3. People who said they don't know the answer. So on average in Wisconsin, 1 out of 5 questions, people said they just didn't know the answer. I think we should be encouraged that people say they don't know, particularly that bond question, to just say, I don't know the answer to that question rather than guessing. Other questions that they asked were not about necessarily knowledge, but about shopping habits. So about 37% of people in Wisconsin and about 32% nationally say they shopped around when they got a credit card. Similarly on auto loans, about 47% said they shopped around versus 44% in the nation. And then credit reports. We've talked a lot about credit reports in the past. Getting a credit report and monitoring your credit is an important task for anybody to do. You can get your credit report 3 times a year, which is why we've promoted the 2266-1010, February 2nd, June 6th, and October 10th, pulling your report from each bureau campaign. But about 39% of people in Wisconsin say they did pull the report in the last year, and 42% said nationally they did that. The 2012 survey we expect to see out in the next couple of months. It's going to have many of the same survey items as 2009. It's going to continue to have this Wisconsin subsample, so we'll have a nice set of data for the state itself. And then there's a military subsample, just like in 2009. There's going to be some new questions added to measure financial education, particularly financial education offered through schools. So we'll have some better measures of that. But excitingly, there will also be a subsample that will be tracked over time using the American Life Panel. I don't know if there'll be enough for Wisconsin to say much about trends in Wisconsin, but we'll be able to link individuals over time and see how behaviors change and relate to other questions as well. Just to pause a little bit and think about issues for low-income people. And oftentimes, low-income people are thought to be financially incapable, and I would argue that's actually not the case. That financial capability is something that people are capable or incapable at all income levels. Oftentimes what's true about low-income people is that they can face a negative shock, so a health shock, a job shock, something that impacts the economics of their family, and they just have less cushion, and so being able to manage that is important. Other people who may have financial capability problems are people with low reading literacy or more numeracy, people with disabilities, people who show cognitive decline. And then, these issues are more important to people who don't have as much experience with financial markets, who are having trouble adapting to new technologies, whether it's card-based payments or those kinds of things, or just dealing with new financial decisions like how to manage your healthcare options in your healthcare insurance programs. That creates lots of stress and emotion that obviously can impede people's financial capability and ability to make decisions. This is a nice model, I think, that shows the links between behavior and knowledge and experience. So we oftentimes think that if we teach people knowledge, that changes their behavior. But we know that there's a sort of feedback loop between what people have done, what skills they've learned, and then their attitudes. What's their perception and how do they think about behaviors and how do they think about finances? And some of that is based on personality. Some people have more or less interest and more or less comfort with financial issues. And so we have to think about those personality issues as we think about financial capability and how to design programs across the lifespan. I think it's also important that we have to remember that we don't always know the right answer. So if you think about people who are using the 19% of people in Wisconsin that are using some kind of alternative credit product, you might say, well, payday loans are very expensive. It's $15 per 100 to borrow, and if they do that every month for all year round, that could be a 322% interest rate, annual percentage rate on those loans. That's too expensive. We should tell people not to do that. But if you think about it, and people have no other option, and if they don't take out the payday loan and they overdraft, that could be an even more expensive option. Or if they get their utilities cut off, that could be an even more expensive option. Financial capability means being able to make trade-offs in the moment. It doesn't always mean that doing something or not doing something is the right or wrong answer. It's having the ability to make those trade-offs and to have access to the information to make an informed decision. Likewise, I think sometimes financial education says it's always good to save and always good to save more. But we also know people who have, say, interest rates of 25% on a credit card, and it makes a lot more sense to pay that off than to put money in a bank account that earns 1 or 2%. So we have to make sure that we help people understand their options and not always try to tell them what the right thing to do is, because it really depends on the context of their situation. Again, financial capability is more than just information. It involves advice and it involves mechanisms. Mechanisms like automatic deposit as well as access to banking services. So it's really a broader, more comprehensive way to think about this. Information is still critical, and it's not that we aren't going to do financial education. It's that financial education has complements in terms of advice and products. And of course, education has its limits. I think the health field is one that we can look at, where despite vast knowledge about education and exercise and nutrition, we still have an obesity problem. And so we have to be realistic about how much impact we can have on behavior. And really, I think somewhat realistic about how much people are going to change just with information alone. So overall, I think the takeaways here are that financial capability is different from financial literacy. What's neat about the FINRA data is we now have the ability to measure not just knowledge, but also behaviors and attitudes. This, I think, helps us understand a little bit more of the context in which people are making decisions, and perhaps helps us think more about a larger well-being approach. People often tell us that personal finance and finance education is boring, but they are interested in thinking about the security of their family and about the issues that face them personally. I think we also have to be mindful that information can sometimes be overwhelming. Keeping information simple and tying it back to goals, to intentions, to behaviors, and then reminders to take action. All this suggests that context matters. I think anybody who's been involved in consumer education and financial education knows this, that families matter, that local institutions matter, that organizations and neighborhoods matter. And so we have this sort of nested model of people within greater institutions. And we just have to be mindful of that as we design programs around financial capability as well. Thank you for tuning in today. Again, this is part of the financial series at fyi.uwex.edu/financial series. Typically, these are the third Monday of the month, although we do take the summer months off. My contact information here is listed. Again, it's Michael Collins, and I thank you for your time.